Welcome back to Explain the Charts. Today is Monday, March 16th, 2026, and we are diving deep into the NZDUSD pair. The market is currently navigating a complex environment where geopolitical tensions are clashing with central bank policy. As of this morning, the pair is trading near the 0.5818 level, showing a modest daily recovery after a significant period of selling pressure. We are seeing a high level of volatility across all major currency crosses, but the Kiwi dollar pair is particularly interesting right now. The global landscape is dominated by news regarding the conflict in Iran, which has sparked massive risk aversion among investors. This geopolitical uncertainty has bolstered the US dollar index, or DXY, which is currently holding firm above the 100 mark. Additionally, energy markets are on edge with WTI crude oil attempting to reclaim the $100 level following reports of port attacks in the UAE. For a risk-sensitive currency like the New Zealand dollar, these safe haven flows into the USD create a persistent headwind. However, there is a counter-narrative forming as market participants weigh the latest economic data out of China. With Chinese industrial production beating expectations at 6.3%, there is some underlying support for the Kiwi as a proxy trade for Asian growth. Looking at the daily chart, we can see the broader context of the recent slide that has lasted for 4 consecutive days. Technically, the pair has been trading under significant bearish pressure, remaining below its 20-day and 50-day simple moving averages. The SMA 20 is currently positioned at 0.5944, while the SMA 50 sits higher at 0.5981, acting as dynamic resistance. One of the most critical observations here is the breach of the 200-day SMA, which was previously a major support zone at 0.5828. Falling below this long-term moving average often signals a structural shift in sentiment from neutral to bearish. Despite this, we are seeing a small bounce today as the pair defends the psychological support area near 0.5800. The 52-week range shows us that NZDUSD has traded between a low of 0.548 and a high of 0.612, placing us toward the lower end of that spectrum. Economic signals from the Reserve Bank of New Zealand are also providing some volatility, as inflation remains sticky at 3.1%. Speculation is growing that the RBNZ may need to be more aggressive with rate hikes in September and December to combat rising airfares and petrol costs. This creates a divergence between the bearish technical structure and the potentially hawkish fundamental outlook for the NZD. On the US side, investors are waiting for the PCE price index and GDP data to confirm the next move for the Federal Reserve. The US dollar's strength is currently defensive, driven by its status as a global reserve currency during times of war. If the Iran conflict escalates further, we may see the US dollar continue its dominance regardless of domestic economic data. Conversely, any signs of de-escalation could lead to a sharp reversal as traders exit safe haven positions. We must also keep an eye on gold, which is struggling near the $5,000 mark as rising energy costs fuel broader inflationary fears. Now let's switch over to the 1-hour chart and narrow our focus to the late February and early March period. In this specific range, we can clearly see the breakdown that occurred as the pair fell from the 0.606 resistance area. Notice how the price struggled to maintain any bullish momentum once it breached the 0.5950 level on February 18th. Each attempt at a rally was met with heavy selling, creating a series of lower highs and lower lows. The hourly candles show that volatility spikes often coincided with news headlines regarding Middle East trade disruptions. The volume data suggests that transactions were particularly heavy during the Asian session, likely reacting to the Chinese retail sales data. We can observe a support cluster forming around 0.5850 during this period, which has now turned into a formidable resistance zone. The 1-hour timeframe highlights the persistent bearish trend that technical indicators like MACD and ADX were flagging. Traders who are looking at the hourly moving averages would have seen the death cross as the short-term averages crossed below the longer-term ones. This timeframe provides a clear picture of the selling pressure that ultimately led to the breakdown towards 0.5800. It is also worth noting that the pair saw several gaps lower at the weekly openings during this window. These gaps are representative of the extreme risk aversion and the weekend developments in global geopolitics. If you're an intraday trader, this hourly structure has been a masterclass in trend following to the downside. However, as we approach the 0.5800 floor, we are starting to see the bearish momentum fade on the relative strength index. This slowing momentum could be the first sign of a temporary bottom or a period of consolidation ahead. To get an even more granular look, we are moving to the 15-minute chart for the period between March 11th and March 13th. This view shows the immediate reaction to the most recent headlines that sent the pair to its 7-week low. On March 11th, we saw a tight consolidation range between 0.591 and 0.594 before the breakdown accelerated. The candles on the 12th show a sharp drop in price as rumors of potential central bank intervention began to circulate. Each 15-minute candle represents the rapid-fire decision-making of the market as geopolitical risks increased. The low of 0.5758 was touched briefly on March 13th before we saw the current recovery effort begin. This V-shaped recovery attempt on the lower timeframe suggests that there is still significant buying interest at these lower levels. Look at the volume bars during that bounce. They are noticeably higher, indicating that institutional buyers may be stepping in. Resistance is currently being felt around the 0.5820 mark, which was a previous support level. For a short-term bullish reversal to be confirmed, we need to see the price close and stay above 0.5850. On the bearish side, any close below 0.5750 on this time frame would open the door for a move toward the 0.5700 psychological floor. The 15-minute chart is where we can see the impact of high-frequency trading reacting to every headline about the Strait of Hormuz. It also allows us to see how the New Zealand dollar behaves during the overlap of the London and New York sessions. Liquidity remains decent, but the wide spreads during news events make this a challenging pair to trade with tight stops. The overall structure here remains fragile, but the immediate downside pressure has stabilized for the moment. Returning to our daily view, let's discuss the reasons to be bullish or bearish from here. The bullish case relies heavily on the RBNZ following through with their projected rate hikes to combat inflation. If the New Zealand economy shows resilience in the upcoming Q4 GDP data, the NZD could recover on a yield differential basis. Additionally, any resolution or stabilization in the Middle East would likely see a massive sell-off in the US dollar, aiding NZDUSD. Technically, an oversold bounce is overdue, and reclaiming the 0.5850 level would be the first major bullish sign. On the bearish side, the trend is undeniably down, and the pair is trading below all major moving averages. The persistence of high oil prices will keep the Fed hawkish and the USD strong, which is inherently bad for the Kiwi. If the market continues to price in a delayed rate easing cycle from the Fed, the path of least resistance remains lower. We are looking at key support levels at 0.5760 and the major psychological level of 0.5700. If those fail, the next historical target is the 2022 low near 0.5510, though that is a long-term extreme. Resistance levels to watch on the upside are 0.5850, 0.5900, and the heavy supply zone at 0.5950. When deciding when to trade, watch for a clear break of the current range between 0.578 and 0.582. A breakout above 0.5826 with strong volume would be a signal for a potential long trade towards 0.5900. Conversely, a break below 0.5770 would likely invite more short sellers to target the 0.572 area. Keep your eye on the news feed for any updates regarding the Strait of Hormuz, as that will be the primary driver of volatility. To recap, our main support levels are 0.5760 and 0.5700, while resistance stands at 0.5850 and 0.5950. In my unbiased prediction, there is a 60% likelihood that the pair will test 0.5750 again if geopolitical tensions do not ease. This scenario is reinforced by the technical sell signals we are seeing on the MACD and the breach of the 200-day SMA. There is a 40% likelihood of a rebound back to 0.5900, but this would require a very hawkish RBNZ or a breakthrough in peace talks. Conditions to watch for include the upcoming US GDP data and the RBNZ policy decision. Inflation will remain the key metric to watch in New Zealand, as it dictates the central bank's next moves. Remember to use proper risk management in this high-volatility environment. The current market state is driven by headlines just as much as it is by the charts. Keep your charts updated with these levels and stay patient for a high-probability setup. We will continue to monitor the NZDUSD pair as the global situation evolves. Thank you for watching this in-depth analysis on Explain the Charts. Please remember that this video is for educational and informational purposes only. It does not constitute financial advice, and trading currencies involves a high level of risk. Always do your own research and consult with a professional advisor before making any investment decisions. Good luck with your trades, and we will see you in the next analysis.